It's been a tale of two markets this year. Local stocks struggling to break out, while bonds have been quietly rallying. Yields have pulled back sharply from last year's highs, driven by expectations of rate cuts and strong demand at recent auctions. But with government borrowing set to climb to fund a record 19 trillion peso debt by 2026, the question is, can this momentum hold? Joining us now is Cristina Ulang, the research head at First Metro Investment Corporation. Hi, Cristina. Good morning, and thanks for being here with us.
Good morning, Mikey.
Okay,
good morning.
Good morning. Okay, lots to talk about. Let's get started. First, let's talk about the macro stuff and the market drivers. Q4 is just around the corner. With inflation at multi-year lows, more interest rate cuts expected, and GDP growth expected to pick up from about 5.5% this year to about 6% in 2026. As we wind down 2025 and head into 2026, do you expect the mood, the momentum to shift?
Yeah, very bullish about 2026, and we're projecting like 6% GDP growth. And we view 2025 to be the trough year. And what's really positive for us is our low inflation. Remember the 0.9% inflation for July. And I think that's going to give BSP a lot of flexibility to cut interest rates, maybe more than 50 basis points. 25 this month, and then another 25, and hopefully another 25. Because the top priority now is really GDP growth, because we're coming from like 5.5%, and we should be at 6% next year, on hopes that interest rate expenses is going to be lower, and that there will be more investments, capital expenditures from the corporates, and that our consumer confidence will really improve because of the still good employment numbers and then low inflation.
Yeah,
fourth quarter will be critical. I'm excited about the fourth quarter.
And seasonally, the fourth quarter is really better. That's when consumption really picks up, and when OFW remittances come in to fund consumer-led growth. Okay, Cristina, the bond market has been very lively. How much of that rally is anchored on the low inflation, and how much of it is simply the markets front-running the lower interest rate environment?
Well, risk appetite now is a bit low when it comes to equities. People and investors are a bit hedging against volatility, and so the safest way to do it really is to go to fixed income. And so we're seeing lively trading in the fixed income, a lot of churn, and then some profit taking. And given the fresh issuances of the government, so there's upside, and of course the BSP in the background cutting rates potentially more in the second half. So this is giving fueling the excitement over the fixed income market. And so the latest RTB has been gobbled up like several times oversubscribed.
Yeah, not to mention Q2 earnings have been subdued, so that's not looking great for equities. But I mean, so we have that divergence between stocks and equities. How long do you expect this to last, and what might change that?
Well, I have two things that are really critical. Number one is the sustainability of inflation, which is very encouraging because global commodities prices are low, and then oil prices low, and then all of these geopolitical concerns in the Middle East are easing, given and there are talks about between Ukraine, Zelensky, Mr. Trump, and then Mr. Putin. So hopefully, all of these are contributing to the easing of geopolitical tension, helping to lower global commodity prices, and also the oil prices, very critical. And then second, another factor would be weather, because we're so vulnerable to these weather disturbances. Remember, our storms last year were about 13 to 16 storms in the second half of 2024. So I just hope we continue to have benign weather in the second half. And it's good news that what is expected is bumper harvest, rice. No? That's why we have this temporary ban on rice imports, because we're expecting bumper harvest. So that should continue inflation being on the low side, and I think that's very critical. And the weather, and of course, efficiency of our supply chain. So I think this is going to improve the backdrop for corporate earnings in the second half, and then help us achieve the corporate earnings that we're hoping for this year and next. We're seeing like 8%, 8 to 9% corporate earnings, and the first half has been in line with the 9% earnings expectations. It's just that some big names have not shown very good relative to expectations, some big names. But one outperformer really is GT Capital,
Mm-hmm.
like 31% growth to 18 billion pesos. And what is really critical about this is that it's like a microcosm of the economy. Kasi there is car in GT Cap, car manufacturing, and then banking. So if you're going to look at the overall result, it reflects the economy, the
Okay.
Philippine economy. And so I am hopeful that we will be seeing a recovery in the second half
Yeah.
of this year.
Okay. So, speaking of the economy, let's talk about RTBs. The government just raised over ₹500 billion for its latest RTB issuance. That's nearly 17 times oversubscribed. I mean, 17 times above its target, rather. What does this strong demand tell you about investor appetite right now?
Mhm. Well, investors are really trying to be on the safe side. They're trying to take care of their portfolio. There's a lot of riskiness, externally and internally, a lot of sources of volatility. And so the best way to really hedge and achieve your return would be fixed income. And so
Mm-hmm.
we're seeing this a lot of interest also on the part of not only of the part of the institution but also on the part of retail investors. We have all of these channels through which they can invest. We have the GCash, we have the Land Bank, DBP, and then OFW Bank, and then of course the direct the PH Bond website, and then directly through the BTR. So all of these channels are encouraging our Filipino investors, retails, to participate. And I think this is going to be a continuing thing, tradition, and expanding, of course, our capital markets. And given the SEMEPA, which is there, very supportive of the development of the capital markets. And then eventually, PERA hopefully gets off and takes off,
Mm-hmm.
given the incentives.
Yeah. Okay. You mentioned retail investors. Let's talk about retail participation. That has surged with the RTBs on GCash and other apps. Do you think this is a turning point for financial inclusion in the Philippines, or do you think institutions will still remain dominant? What's your outlook for that in the second half and as we enter 2026?
Mm. Well, I see a lot of upside in terms of the fixed income space. First of all, right now, if interest rates are still high, we have the 5-year, the coupon for the RTB 5-year at 6%, doing at 5.9% now, then this is very attractive. Given that interest rates are going to come down, the BSP is going to cut interest rate. The Fed is also cannot hold off forever. They will also cut. And interest rate and interest expenses are going to come down. And your time deposit and your savings deposits won't give you the yield and the return that you want. And so it is important that you're able to lock in at this current rate, 5.9, and then it's going to drop. So from a yield standpoint, you're gaining. Also from a price standpoint, for those that are trading and churning the market, they will see also price improvement. So
Mm-hmm.
it's really a very good opportunity now, given the backdrop of dropping interest rates
Mm-hmm.
and low inflation.
Uh-huh.
So good opportunity.
Yeah. Speaking of the backdrop, of the economic backdrop, another thing we're all looking at is the Jackson Hole Symposium in Wyoming. Markets are watching for the Fed's decision, specifically what Fed Chair Jerome Powell is going to do. What are your expectations, and how might that shape us here at home?
So the two indicators to look forward to or to watch out for would be U.S. inflation. The latest U.S. inflation is a bit faster. The wholesale prices are like inching up 0.9% month on month above the expectation of like 0.3. So it signifies that although there's a stable inflation in the headline, U.S. headline inflation at 2.7, but still it's far from the neutral rate of 2%. So I think that's giving the Fed incentive to hold off, to be steady, because they are afraid that inflation coming from the U.S. tariffs, higher U.S. tariffs, is going to really give a fallout. It will have a backlash on the economy. So they're trying to be very careful. But eventually, the U.S. economy will have to bear the brunt of the higher import cost. Companies are paying the higher import cost. And so the Fed will eventually try to avert any deeper recession or any deeper slowdown happening in the U.S. Remember, there is a midterm election happening in the U.S. So they have to really spice up the economy. And they
Yeah.
cannot hold off like steadying. And Trump is also very impatient with the current Fed chair. And there's going to be a replacement come June 30, 2026. And so there are expectations that that Fed chair might be replaced with a lot more dovish replacement. And I think that's giving us hope that interest rates are going to come down in the US. providing very good backdrop for Philippine interest rates also to go down because the dollar is going to weaken if in US interest rates is going to come down. That's
Yeah.
going to allow the peso to really hold steady versus the US dollar.
Yeah, if Trump gets his way, there might be a change there on that leadership front, but we shall see. But what they do matters so much to Philippine markets, as for our bond and equity markets, especially as we head into Q4. It's going to shape that. Now, let's talk more about the fiscal outlook and our debt load. The government debt is projected to hit 19 trillion pesos by 2026, pushing the debt to GDP ratio to above 60%. How much of a concern is this for bond investors, Cristina, or are falling yields cushioning the risk?
Well, if interest rates are gonna come down, then interest expenses of government and the debt burden, in as far as interest payments concerned, is gonna come down also. That's going to ease, and I think that's one positive factor. Secondly, if we need to grow in 2026 and achieve a growth of 6%, we need to fund our fiscal stimulus. We have heard the president talk about very populist measures, very supportive measures for the masses, social services, economic services. I think he's proposing like 6.7 trillion worth of budget for next year, which is 7% higher than this year. So it's very ambitious, it's very aggressive. That's very good for our growth prospects. But the question is funding. And some people are worried that we may be over borrowing. But I think it's always a relative thing. If you're able to grow the economy 6% by way of borrowing, make a very good use of your resources, borrowed funds, then you will be, I think we're going to be successful in bringing the economy to a re-acceleration path. I think that's the most important thing. But imposing new taxes is not an option because it's going to be contractionary to the economy. We need to grow. We need to be very supportive. And I think borrowing would be one viable source of funding. It's just that we really need to make use of it very judiciously and
Yeah.
look at the most impactful way of using the money so that we will achieve a growth of 6% next year. So I think that's very tricky and that's very requires a balancing act.
Yeah.
Really.
We have to use the money efficiently, and the spending needs to translate to productivity gains. So credit rating agencies are watching us very closely, with growth expected to pick up, inflation expected to stay low. Given this trajectory, are we on track for a credit rating upgrade?
Mm-hmm. I think really this is going to be testing period for the fiscal managers because it's really hard to grow the economy and then look for funding
Yeah.
and at the same time manage your debt. So the achievement, the focus would be combination of debt sustainability and fiscal sustainability. And we know how hard it is. We've seen the Pinoy government, GMA government bring down the debt to GDP from 70% down to 36% of GDP, and now we're seeing it higher again, 60%, 62. And then under the new definition, it's down to 57%. And so we really need to put resources where they ought to be and then really develop the local capital markets so we are able to mobilize resources for the funding of the government to fund this fiscal stimulus that we badly need for next year, which will be complemented by a monetary policy stimulus also. So we have this the combination of all stimulus in order to bring us to 2026. It's just that the weather, I'm worried about the weather. It's always the weather that is very disruptive
Yeah,
because
external
it's hard to
factors.
execute when the weather, yeah, it affects your consumer confidence. You have the flooding. So it's nice to hear these flood control projects being put in place.
And resources put where they ought to be, and also really developing the capital markets, Christina. Also, I wanted to go back to interest rates. That's just around the corner, end of the month. If the BSP delivers 2 rate cuts this year, and that's the expectation for 225 bips cuts, how much further can yields realistically fall from here?
Mhm. By year end, we're projecting something like for the 10 year originally at 6%. But now rates are coming down. So my own, I am thinking in terms of the sensitivity because in sensitivity of the rates versus the rate cutting of the BSP. The rate cutting of the BSP already captures the inflation expectations. And when the BSP cut 25 basis points after the first after this 10-year fresh issuance of the 10-year last April. I noticed that the 10-year rate dropped by 30 basis points from 6.3, 6.27 to 6.0, 6.12, and so there is that sensitivity of like 20 basis points. So maybe if the BSP is gonna cut two times by 25 basis points, I'm thinking we may be hitting like 5.8%, 5.75. So we could be in the range of like maybe 5.9 to 5.75 for the 10-year.
Okay.
That's for the 10-year. But for the entire yield curve, we're seeing it like lower. The entire yield curve is gonna come down. But of course, the short end is going to come down more aggressively because
Yeah.
it's more sensitive to the, yeah.
Okay.
So, invest in the long end also if you have
Okay.
the
Beyond
ability.
bonds, Cristina, what's your base case for the peso and for equities as a tail end of this year?
Well, we have heard the BSP forecast that the current account deficit is going to be worse. It's going to be a lot wider, like 3% of GDP. And then the RBOP, our balance of payments, is expected to be like 6 billion, negative 6 billion deficit year end, coming from $600 billion positive. So these are all negative as far as fundamental impact on the peso is concerned. But why is the peso strong, like dipping to 56 and even touching 55? That's only because the dollar is weak. And I think that's our savior. It's the weakness of the US dollar going into 2026 because the Fed might cut to avert a slowdown in the US economy. And if that happens, then the peso is going to be a bit supported at the 56 level, 56, 57. Best case could be close to 56, 55, 55, 80, 55, 75. That's best case. And that's really predicated on expectations of more rate cuts in the US. The reason why the peso is flirting with 58.50, 58.30 is because of the very strong numbers in the US. Strong GDP growth second quarter, like 3% GDP growth US despite the tariffs, and then the Fed chair becoming very hawkish in his statement. So those two factors are supportive of the dollar. But a second quarter of 2026, we don't see that happening anymore because there's going to be a replacement of Powell, maybe a dovish one, and that's going to be supportive of the peso.
Yeah. That said, Cristina, just to highlight, what is your year-end target for the peso and equities?
For equities, we're still hoping that the rate cuts are gonna come through, maybe a lot more aggressive than what the market expects to be like 50, maybe an additional 25. And then if we hear the Fed talk about dovish rhetoric, and then saying that they could be doing more rate cuts, then we can see the PSA moving higher, like to 6,900, 7,000. So that's really predicated on the aggressiveness of the rate cuts here and abroad. And then secondly, if our weather is good second half, and then we're able to see fourth quarter GDP, third quarter GDP growth really rolling up and improving towards at least the 5.7%. Ayan, that's going to be a best case. That's gonna bring the PSA to 6,900, 7,900. Earnings growth of like 9%. We're still hopeful 9% because the first half, if you average the 28 companies composing the PSA, it gives you 10%. It's just that some companies have not beaten expectation. That is where the a bit of a risk of is coming from.
Yeah. And last question, Cristina. As the government just raised over ½ trillion pesos in the latest RTB issuance, are you worried that this might sap up some liquidity in our financial markets?
Not really, because this is part of the program borrowing already. This has been telegraphed to the market. They're going to be like in the first quarter, this is how much they're going to borrow. Second quarter, this is how much they're going to borrow. And there are some maturities, like 800 billion worth of maturities coinciding with the fundraising. So if you're going to compare the 800 with the 500 raise, then you have an excess liquidity of 300 billion. So where is the crowding out? And secondly, the economy is operating at below potential GDP. Our GDP is 6%. We're only at 5.5%. So what does that mean? It means there's no overheating in the economy and inflation is low. So I don't see any evidence of crowding out. the market really is basking with the fact that we have this liquidity to reinvest. And the market is afraid that they cannot reinvest at the same high yield. So this is really the opportunity to lock in the yields because interest rates are gonna come down.
Yeah, use that liquidity to reinvest. It's just about timing. All right, thank you so much, Cristina Ulang, the research head of First Metro Investment Corporation.
Thank you. Bye.